How we doing, people? Welcome to my new channel, MP3 Finance. Little branch off of MP3 Fitness. Just a reminder, I'm an idiot on the internet. This is not financial advice, all that blah, blah, blah. I'm just a dude talking. I'm not your mama, I'm not your papa. Any financial decision you make, you should be responsible for and understand what you're doing. This is all just food for thought. So here we go. This is the stock market, S&P 500. This is from 1999. We had the dot-com boom and bust. Bull market, housing crash. Housing crash is when we started quantitative easing. Quantitative easing means we're going to be buying assets. We're going to print money like crazy. We're going to stimulate the economy to promote growth. Oh boy, did we grow. So after 2008, pretty large bull market with some small pullbacks here and there. And then we got to 2020, the COVID crash. And we all know what happened at the bottom of the COVID crash. We're going to drop rates to zero, and we're going to print more money than has ever been printed. I think we printed like 30 to 40% of all dollars in circulation at that time. And we still print today. And then you can see we've got this recent pullback. Small little pullback when you look at the scope of things, but this is a 1 month chart, so we're pretty zoomed out. The reason I'm showing this is so we can decide, or we can get some insight on what's coming next. So are we going to have a big correction like we've had in 2000 and 2008? Or is that it? Because we're already starting to recover here. We've kind of had a little bounce there, and this is the 200-day moving average, and looks like we're just touching it right now as well. So that's the question that everyone's trying to figure out. And what do you do? Nobody really knows until after the fact, because this could turn out we could be right here in the cycle, or we could be right here in the cycle, and we run into some big bull market. The difference in these crashes and our crash right now is this is when we started quantitative easing. They just handed out the Nobel Peace Prize to Bernanke, was the Fed chair at the time of 2008, and he was the one that started this stimulative market. So that's the market. Let's look at a couple other things. We're going to look at interest rates. Here's the 10-year bond. So this is a pretty good gauge of interest rates, and this is again a monthly chart. We go back here to the 30s, going down, climbing up. Right here in 71 is when we took the US dollar off the gold standard. So the dollar is no longer pegged or backed by gold. It is backed by the faith of the US government and the faith that they will not default. So not backed by anything except for faith. We won't get into that right now. But anyways, you could see we peaked here in the 80s. We had to raise rates really aggressive because the 70s, there was hyperinflation because of all the money printing that was going on in the 60s. And then we depegged from the dollar, gold in the dollar, depegged. So we had massive inflation, and to beat inflation, they had to raise interest rates higher than the actual inflation rate. So if inflation was 13%, they had to raise interest rates to 15%. So that way it could break inflation's back. And then from there, you could see we are going down. And we start to have these cycles where interest rates go up and then they cut them. They go up and then they cut. So they raise rates and then they print money. Raise rates, print money. Stimulate and non-stimulate. So now we get to COVID. COVID happens, cut rates to zero, print money like crazy, and the market recovers. The economy recovers, society recovers somewhat. So now they got to pull some of that money back because we're seeing crazy inflation all over the place. And so to do that, they have to suddenly increase rates drastically, which is where we're at today. So now the question is, where do rates go? Do they keep climbing higher, or do they have to cut? Because we're seeing just a little dip in the market, But we haven't seen the full effect of a big recession. That's typically when you see large rate cuts, is when there's a lot of problems in the economies. And we haven't seen the full effect, is what it seems like. But who knows? That could have been it. That would be the weakest recession we've ever seen. And if you go back to the S&P 500, every time we bottom out, we rip out of it. Bottom out, rip out of it. Bottom out, rip out of it. COVID, bottom out, rip out of it. So is this the bottom, or is the bottom down here somewhere? Nobody knows. We will only know after it's done. There's one other thing I want to look at. It's the dollar. It's just interesting to look at. I don't know if there's anything actionable that I can say from this, but you can see the dollar gets really strong and then it just tanks. Consolidates here, gets really strong, tanks. And right here, we've got a period here where we're really strong. This was COVID down here, and then we ripped out of it, and we're really strong because we're raising rates. People want dollars because we have the best, I like to say we've got the best fake money. Again, we won't get into that because no currency is really backed by anything except for that government's ability to pay its debts. And the US controls the world's monetary system because every country needs dollars to trade goods. Every good trades in dollars. Most goods around the world trade in dollars. So if you're in Australia and you're buying copper from China, you got to do that with US dollars. So just some things to take into account and food for thought. Because we're kind of at a point here where which way are we going? This is the NASDAQ, which is technology stocks. And you can see NASDAQ rips from the 70s, rips. A lot of technology improvements there. Dot-com bubble crash. Then we rip up 2008, crash. And then we have this big rip, little dip. So it's just interesting to look at when you zoom out on things. And you can even look at some individual stocks. Let's look at Apple. So, boy, that's a good stock. So Apple here, you can see in the 80s, rip, dip, rip, consolidate, rip up, 2000 crash, consolidate, rip up, 2008 crash, and then off to the races. So even if you're holding some of the best companies in these tumultuous times, you're going to end up well. I mean, you could see Apple here. It doesn't have that big boom and bust like even the S&P 500 did. A lot more swings in the S&P 500. This one, I got all kinds of stupid lines. Yeah, here's the S&P 500. Because if you were to buy, even if you were to think, okay, it's over, I'm going to buy here at 1200, it would have taken a long time for you to get your money back unless you sold here. So I think it's important as a individual investor. A lot of people, they have index funds, they have these funds, but here's the Dow, another big fund. It's just food for thought. I think it's at a time like this, you want to own assets, but you want to be very specific on what assets you own, because there's going to be a lot of things if we do make a round trip on the S&P 500. If we are going way down lower, if we're going to have a dip like this or like this, you want to have the best of the best stocks like an Apple, because an Apple will be okay at a time like that if they can keep up with their sales. So all food for thought, just something to think about. Anyways, no actionable items here, just food for thought. Cheers.